Hello there, Maverick Traders, and look at that date. The end of the year is here. I always love the end of the year. That's when you stop, you run all your numbers, you look at all your results, you either pat yourself on the back or you chastise yourself for the mistakes you made. But at the end of the year, it all closes down and a new year is here. And here's what I love about trading. The market won't remember what you did in 2024. So if you had a great year and you patted yourself on the back, don't get too full of yourself. The market doesn't care what you did in 2024. So you better show up in 2025 ready to go again. And if you didn't do so well in 2024, shake it off. The market doesn't remember that. Let's make sure we go into 2025 ready to go as well. So I'm excited for it, but I always love to do a look back, a review, look at the numbers, all the fun stuff, wrap that year up in a bow, and then move onward. But we still have a few days left in 2024, so let's get going here. All right, let's take a look at the news of last week. It was a holiday shortened week, so look, it was a quiet week, and we had updates on Monday, Tuesday, markets were closed on Wednesday, and then we had Thursday, 3 updates, and then Friday basically wiped it all away. Now, we did close mildly positive, but we did get a pretty big sell-off on Friday, and it was really led by large cap tech. Large cap tech has been bulletproof. For some reason, again, I looked for news, I looked for everything. Really no reason. We just got a big sell-off in large cap tech on Friday. We do continue to see the bonds get higher. So the bonds are going up and up and up. The bond yields, which at some point that is going to cause the stock market to at least worry and at least maybe have some more volatility. We're up to 4.65 and it looks like it wants to go higher. We got the US dollar cranking higher. All of these things are not good for stocks because anyone who exports products to other countries with a strong dollar, they're making less money. So corporate profits go down. So higher interest rates, corporate profits typically go down. Higher dollar, profits go down. Not really a great sign for the market going into the new year. As far as economic reports, we'll talk about these. There wasn't anything really important. We had durable goods and consumer confidence. You can see they were all down below expectations. However, we did get this report on Thursday, which was unemployment claims at 219,000. That is a very, very low number for unemployment claims. This is telling the Fed that yes, some of the numbers are softening, but the labor market is still very strong. Not a lot of people are getting laid off. So again, this is that continued mixed economy that we see. Some numbers good, some numbers bad, but overall showing still a resilient economy. So nothing has really changed when we take a look at these news points from this last week. So let's take a look at the final numbers on the week. We had the Dow up 0.25%, the S&P up 0.2%, the Nasdaq up 0.75%, and the Russell basically flat. Small caps continue to underperform. Large caps continue to outperform. We've been talking about this lately, and we saw this especially last May and June. We saw interest rates were creeping up. They got all the way up to the 5% area, and the rest of the market was really selling off, really having a hard time with it, except for the large cap tech stocks. They zoomed. We're seeing the same thing here. Large cap tech outperforming. However, in July, do you remember what happened in July? July, large cap tech got crushed, absolutely crushed for the whole entire month and had a really big pullback. Of course, they've recovered since then, but I'm looking at really the same pattern here. As interest rates get higher, large cap tech outperforms, and then at some point, it's too high and they all crack. Oil, gold, basically flat on the week, but let's jump into the charts. Last week, we talked about the pierce of the 50-day moving average, but we recovered. This is a close on Friday. So we closed right at the 50-day moving average last Friday. We got Monday, a little bit of a sell-off in the morning and then closed at the high. That was a really nice confirmation candle that this was a low. So that was a really good confirmation of that low. We bounced back, but you can see we ran into some overhead resistance right at this level. And we put in a lower swing high. Now look, this is just one candle. I'm not going to freak out over one candle. It does have a nice long lower shadow on the bottom to where we close off of that 50-day moving average, but we are definitely in between a range. And right here, right now, I'm looking and saying, okay, I am above the 50 a little bit. I'm below the 20 a little bit. The moving averages are flat. That's a zero. That's a zero. However, I do have some trouble here. I've got lower swing lows and I got lower swing highs. So that is not a great thing to look for in the market. Now, I'm going to be projecting my opinion. Take this for what it is. We're going to react to the technicals. But I'm really looking at these two levels. So let's call it 60-30 on the upside and 58-60 on the downside. I think there is likely a 65 to 70% chance that the first place to get hit is the lower end of this range, 58-60. I think the risks here are now tilted more bearish than bullish. We got this pierce of the 50. We got this rally that put in a lower high. I think the odds are we likely see some bearish price action in the near term. However, I could be totally wrong. If we break out above 60-30, 60-40, guess what? That's telling me we're going to run back up to that 6100 and we're likely going to test it for a new all-time high. I think that's about the odds here. 60-65% that we actually break below and a smaller chance of us breaking above. The rising bonds in the US dollar is really the thing that's making me a little bit less bullish here. We come here to the NASDAQ and it's still very bullish price action on starting. This is just the Qs. So again, this is large cap tech. Came here, we broke out, we pulled back, we held that level. Yes, there was a little pierce. The problem is we had a lower high. Again, this is just one candle. I'm not going to freak out and make a decision. But look at this. This is different. We are in rising territory. This is still a bullish market. Looking at the Qs, there's a greater likelihood that the Qs go higher than the S&P, in my opinion. But if the S&P breaks, it's going to pull down the Qs with it, most likely. We take a look at the heat map for the week. You can see it was generally a bullish week. Remember, we are in the middle of the Santa Claus rally, the last 5 days of every year and the first 2 days of every year. These are generally a bullish time of the year, to where if you take a look at all the past years, this was a bullish period. There's no guarantee that that's what we're going to get, but take a look at this. We got it. We got a mild up week. So that means that we have Monday and Tuesday for the last 2 days of the year, and then we have Thursday and Friday for the first 2 days of 2025. So on Friday, the Santa Claus rally will be over, and then we're going to have to take a look at some other seasonality patterns. We will be taking a look at the January effect, which is a very powerful one dealing with some sectors. Let's take a look at next week. I left this the same, the severe erosion under the surface of the bullish market. Large cap outperforming. Look, I'm still seeing that. Nothing changed here. This week we saw those get hit on Friday, but overall, we're still seeing the same thing. There's not a ton of stocks above their 50-day moving average. Like we usually, sometimes we get to the 75-80% of stocks trading above the 50-day moving average. It's been hovering at 50-50. It's just showing us it's not great. We only had 3 sectors above a zero last week, 7 below a zero. And everything's showing us that there's more weakness than strength in this market. We talked about the Santa Claus rally, and we are going to have a market closure again this week, same as last week, half day on Tuesday, and we have the markets close on Wednesday for New Year's. Let's go ahead and see what we have on the schedule for next week. The only thing I really want to point out is ISM. Typically, the very first Friday of the month, we get the employment report. We are not going to get the non-farm payrolls report. This week, we'll be getting that on the 10th. So this is really the ISM manufacturing is the only real news of any importance coming up this next week. So where are we in the market? We're to zero. We are between the two moving averages and the slope has flattened out. I'm looking at this week, and this is going to be going against seasonality, which I've got no problem going against because my opinion is simply an opinion. I think it's a tough call here on the market because we've got all this weakness under the surface. The S&P is in the middle. The Qs are still bullish, but the rest of the market is really suffering. Where do we go from here? We are in the Santa Claus rally, and usually I would be much more bullish of all the years in the past because things were looking good, the charts were looking good, the technicals were looking good. The problem is the technicals aren't looking good. So yes, I can look at this and say, oh, the Santa Claus rally should be here. But if the technicals aren't showing me that most stocks are going higher, it would be foolish for me to believe that the Santa Claus rally is going to happen this year. It might. It would not be surprising to me if Monday and Tuesday were up days. That would not be surprising at all to me. It would also not be surprising is at the first of the year, we start to see some rotation and we start to see some things fall out of favor, especially the large cap tech. And if the large cap tech gets sold off at the first of the year, it is going to take all of the indices down as they are 31% now of the S&P 500. Let's go ahead and look at some of those sectors. But before we get into the sectors, I'm going to go over the January effect. And it has everything to do with sectors and the strongest and the weakest stocks. We are huge believers in our top-down analysis approach at Maverick. Basically, what we do is we take a look at the markets, we take a look at the sectors, and we basically say we rank everything from the strongest to the weakest as far as sectors go. Now, the basis behind this is lots and lots of trend analysis studies, and here's just one of the studies that I'm going to be referring to. Basically, a very long-term study. Trend following has been the most studied thing in the stock market, and it's absolutely been shown that past performance does indicate future results. Basically, the strongest stocks tend to have the largest returns over the next 1 month, 3 months, 6 months, 12 years. How well something is done is a great indicative of how well it's going to do, including sectors. We've seen that in the last 3 months where the best sectors, which were technology, consumer, and communication services, all kept going up. And the worst sectors, stuff like healthcare, stuff like real estate, materials, they all did terrible. And we're going to see that this week. They all did exactly what they've been doing. So again, we're huge believers in trend. And when you take a look at, these were the findings in this study, that basically they took the top 10% of the stocks. The top 10% of the stocks outperformed the overall market by 40 basis points. And the top 10% of stocks beat the bottom 10% of stocks by 123 basis points. Again, a huge range. Except for January. So there was only 1 month where they did not see the top 10% crush the bottom 10%, and that was in January. And this is what's called the January effect. One of the reasons this comes about, again, I'm going to give you some reasons, and there's probably a billion reasons, but rebalancing is one of those reasons. Portfolio rebalancing. If you do portfolio rebalancing and you're buying and holding, if your tech stocks did really, really well in 2024, you have a date that on January 1st, you only want 20% of your portfolio to be tech stocks and you want 20% of your portfolio to be basic material stocks. Well, basic materials didn't do so well. Tech did awesome. At the end of the year, you might have 30% of your portfolio in technology and only 10% of your portfolio in basic materials. So what you're going to do automatically, and a lot of people do this automatically where it's not a click of a button, it's just automatically done. You reallocate. You sell some of your tech stocks, you buy those material stocks, and then you rebalance it to where you have 20% of each. This is one of the reasons why this happens. I guess also one of the reasons new money comes into the market at the first of every year, and they usually go after the things that are, quote, beaten down, the things that haven't done so well. There's a whole thing about the dogs of the Dow. You buy the worst performing stocks of the Dow, and you theoretically can outperform the market that year. There's a ton of different things going on, but we have to talk about this every time we get to this point of the year, is the January effect is an absolute possibility. And I do think it's going to happen this year. We have a bullish market. We have lots of capital coming into this market. The economy's doing well. I really think we do see a sell-off of the best performers, and I think we see buying of the underperformers. Now, again, that is my opinion, but my opinion is brought by study of what's happened over previous years. We will be watching to see if the January effect happens. If it does, we'll be very quick to change some of the allocations, but we definitely have to be prepared for it to happen. Let's take a look at the sector returns this week. And as I said, our 3 +3 or +2 or +1 sectors were consumer, tech, and comm services. Take a look. They were 3 out of the 5 rising sectors this week. Now, healthcare was one of our weakest, but in the weak category, we had utilities, real estate, industrials and materials, and healthcare. So take a look at that. All of our positive sectors went up last week. All of our negative sectors, 4 out of 5 went lower. This is why we love sector analysis so much. The big question is the January effect going to hit to where we have consumer, tech, and comm services get sold off in January, and things like materials, real estate, and healthcare get bought up? We will keep an eye on it. We have to be aware that it's a possibility. Right, let's go score everything. For the first week, I don't know how long, but I know the first week this year doing the trading room, nothing changed scores. Nothing changed scores. So I'm going to go through these pretty quick because I went through them in more depth last week and none of the scores changed. So -2 in utilities. We have a +1 in comm services. So you can see we are above the 50, below the 20, but the 2 lines are still rising. That's a +1. We got healthcare still at a -3. Ugly low base there on healthcare. You can see not a great bounce. Even though we did bounce this week, not a great one. We go on next to our healthcare. This is -3. Sorry, that was real estate. My bad. Real estate was the one that didn't bounce. Sorry. Real estate number -3. Healthcare -3. A little bit better bounce. But you can see still not out of the woods yet on technical. Still a -3. We come over here to industrials. Was a -2. We're going to keep it a -2 till those lines get a little steeper. But again, same thing. Low base. This is not a good bounce. Not a good bounce. Actually, it didn't bounce. It was down for the week. Here we have the financials. Now, the financials were -1. They almost got back to a 0. When you take a look at financials, it actually had one of the better bounces this week. So I'm looking at financials as a place that got buying last week. You can see we got some really good buying, and then the Friday sell-off hardly hit it. Hardly hit it at all. So while I am still at a -1 on financials, I'm leaning a little bit more bullish here on financials based on the bounce it had. Here we have consumer discretionary. It was a +2. It's still a +2. We have technology. Was a +2. Still a +2. Moving on to materials. Look at that absolutely dreadful bounce. Now, that's the worst bounce we've seen yet. That's not even a bounce. That's just a full-on low base. Materials remains one of the weakest sectors out there. Think about it. We saw healthcare. Healthcare had 4 or 5 up candles that actually had a nice bounce. Not materials. Not materials. It was dreadful this week. And then we have energy here. Same thing. It was up this week, but take a look at that bounce. Nothing to be excited about. This is where we were last week. This is where we are this week again. The only question I have, it's crystal clear where the strength has been. We've been focusing on these on the long side. We've been focusing on these on the short side. Is there a January effect coming? Because I am, I'll use the word worried. I'm not worried, but I'm aware of the January effect. I'm going to make my trades really thinking about, hey, do I really want to put on a bunch of new aggressive longs in tech and consumer? Or do I want to put on a new long in like financials that's actually had a good bounce? And do I really want to go short, healthcare and the worst things that have been just punished into going into January? Or do I want to sit back and see if they have a rotation? And that's exactly where I am this week, is I'm going to sit back and see if they have a rotation. Looking at our trade slots, we had 5 trades roll off, and last week was a nice week of rolling off. We had a max gain in Fox. We had close to a max gain in a Berkshire Butterfly. We had a max loss in ELF. That was not a good one. Had a max gain in Apple, and we had a max gain in Barrick Gold. So 4 out of 5 for pretty much max gains. Not bad, but that leaves us some slots. We've already gone over this. We are at a 0 on our market scale. So that means that we have no +3s, no plus or -3 slots, so we can't go aggressive. We have to be somewhere in the middle. So I'm looking to where to add, and this is where, again, the slots are really nice because this is where you have some discretion. You have some discretion of what slots you fill. And you can see that I've got a lot of room here. I don't have anything in here. So I wanted to fill that. But remember, I don't have to fill them all in 1 week. I don't have to fill them all in 1 day. I can take my time and I can just add. I'm only going to be adding 3 here. It's the end of the year. I want to see if we get that rotation. I don't want to put on a whole bunch of trades right here. So I got a week. I'll take a look at the rotation here at the end of next week. And if I like what I see, I might put on some more trades. But I'm looking to be slightly bearish here in tech and slightly bullish in financials. Now, this is the one time a year you will see me be counter trend of a sector score. And it's because of the January effect. The other 11 months out of the year, you're going to see that I'm pretty adherent to the sector scores. But this one here, I've got no problem doing a -1 in technology. I got no problem doing a +1 in financials. Consumer still looks pretty good. This is where I'm going to allocate my trades. I'm not going to put a lot of trades on. As you can see, we're still staying really close to neutral. But when you take a look at where we are, for the first time in a long time, I'm going to be leaning slightly bearish. And slightly, ever so slightly, a total of a -1 point. Not that I do that, but again, I got one more -1 than a +1. You can see it's even slightly bearish. So let's take a look at the possible trades here. Like I said, I'm in no hurry at all to rush into trades. Financials was a -1. I liked the bounce. I liked the price action it had. So I'm going to look to add a bullish trade. This is Citigroup. I do like, again, made new swing high. Pull back. It did break the 20, but broke it on 1 day. And we put in a good bottom. And take a look. Take a look at these candles here. We have only green candles. Now, this was a down day, but it was still a green candle, meaning there was more buyers than sellers. It gapped down, and by the end of the day, the price was higher than the opening gap down. That's telling me there's still buyers in this stock. Now, do I want to be up here at 75 thinking, oh, this stock's going to run? No. Remember, I'm allocating a +1 trade. A +1 trade is going to be about a 60 delta spread. That's going to be the 69.71. So it's at the money. I'm buying the 69, selling the 671, and basically all it has to do is be above 71 by January 10th. And that's going to be a max gain on Citigroup. Mildly bullish. We're not looking to be crazy bullish or bearish of anything here with the score of 0. We are looking at Albertsons. ACI is the ticker symbol. I've traded this just a handful of times from my career. It's typically supermarkets aren't really what I trade. They don't show up a lot on scans, but here they are. It's on a scan. Just a little background of news. They were supposed to be bought out by Kroger's. The deal was basically blocked. And you can see that the overall reaction to the news after it came out was, hey, you know what? People seem to be okay with it, and I love these last candles. Remember, we had a down day on Friday. Look at that candle. Opened up at the low, closed at the high. Boy, there are buyers coming into it. I've allocated a +1 trade. So I already know I'm going to be doing, again, a 60 delta, which is a 19.20. So basically, I'm looking to the same thing. Buy 1 strike in, sell the at the money. If it breaks out anywhere above 20 and stays up there by January 10th, it's a max gain. Anything below 19 is max loss, and then between the two, it'll be a little bit of gain, little bit of loss. I do like this trade a little bit more aggressive. I just don't want to lean out there with my slots. If you do want to lean a little bit more aggressive, I like this one up to $21. Give that to January 17th. Give yourself a little bit more time. Then in technology, I'm going to be a little bit bearish. Now, there's a whole lot of stuff that I loved. I found so many good bearish setups. So many of one of my favorite setups, we call it the belly flop, where something is bullish move, and then what happens is a big down move, and then it bounces, and it actually bases, and it doesn't go anywhere, and then it breaks down. Those are my favorite ones. I found a bunch of those. The problem is I have a very strict rule that I do not go short things that are above their 50-day moving average. And they were all above their 50-day moving average, so I couldn't break those rules. So I was searching for, okay, what is pretty much doing the same thing, but is below its 50-day moving average? And the first one, after seeing about 10, I saw 10 that I really liked. First one that goes up, has a big fall, and then we basically base, and then we break down below the moving average. This is the first one that came in. Again, I'm only going to be a -1. I could be a -2, but guess what? I don't want to. I want to be mildly bearish here. The stock is at 62.50, so we're just going to split that right in the middle. That means it's going to be 250. So 250 risk, 250 reward. Pretty easy trade. It's a 50-50, 1-to-1 trade. If it goes below 60 by January 17th, it's going to be max gain. If it's above 65, max loss. Pretty simple trade here on this spread. Now, as I said, I only have 3 trades. That's all I'm going to be putting on. I'm in no rush. I got all of 2025 to make my numbers. Why am I going to go out there and spaz out on January 1st? No, I'm going to take this. I'm going to look and see if we get the January effect. If we do, I'm going to be really happy that I'm not overly long in tech, overly long in communication services. And you know what? I'm going to take a look at healthcare and boy, do I have some opportunities to get a short-term long here on healthcare if there is that rotation. So I'm definitely ready to go. I'm just very aware that we could get this sector rotation, and I don't want to be overly committed to, tech that could have this rotation, or overly short in things like, materials and healthcare and real estate. I want to just be light on my feet. Let's see if it happens. If it doesn't happen, we'll go back to selling and shorting those sectors and going long in tech. But I want to keep my options open. Thanks for joining me, everyone. Have a great week and great weekend, and Happy New Year's, everyone. Goodbye.